global for that source of diversification. It's actually come through as quite a practical outlet. And then looking ahead as to say, okay, how does this work at a real level for clients? This part of the portfolio, if it's producing, say, 7% income a year, that's producing $17,500 in income here. If Australian shares, as any Australian share portfolio would be at the moment, producing about 6% income when you include the value of franking credits, which you get back in a super environment, that's going to be producing about $24,000 of income. If we say the property investments are producing, say, 8% return a year, that's going to be $12,000 worth of income. And global shares tend to have a lower income, so say 3%, you've got $6,000. And you can see, so there's $42,000 worth of income coming back from the growth assets each year. The important thing is this income tends to increase over time quite reliably, far more reliably than the price of assets. And you've actually set yourself up quite nicely by looking at the way these asset classes relate to each other, the way income is produced from the assets, and the needs you have for income in a portfolio. If you were significantly younger and maybe only had $10,000 to invest, it would still be a similar process. You might say, okay, well, what I really feel I need is $5,000 set aside in case I lose my job for a time, have a medical emergency, something like that. So what are my short-term needs? And the rest would be in growth assets. But if you're regularly investing in the portfolio, you might be putting an extra $1,000 a month that might go completely to the growth assets. So it's a way of thinking about asset allocation by incorporating the way asset classes relate together and also then the income need for investors. And I think one of the good things about this, and I wouldn't say, you can invest those asset classes in a lot of ways. You might say, for example, Australian shares, I'll use a broker and buy a portfolio of direct Australian shares. But for global shares, I'm not as comfortable, so I'll use either an active managed fund or an index fund. So, different ways of putting that portfolio together, different compartments of it. Within global shares, I would make the argument, I think the argument can be made on a few levels that my preference is certainly unhedged global shares. So a couple of reasons for that. One is they have a lower correlation, a lower relationship with Australian shares with similar long-term returns. So there's a greater diversification benefit. Also, hedged shares often pump out more distributed capital gains or distributed income to investors because they're making money off the hedges. And also, they tend to have slightly higher costs in the long term because there is a cost in hedging a portfolio. So I think there's three reasons. It's subtle, but they would why I tend to favour that way. The other issue in diversification then is actually within asset classes that we can't touch on in any detail here. But it's the idea that small companies in different markets have different performance. And I think anecdotally we'd probably see that. We see those years where small company funds might pump out a return of 60, 50 or 60% and then you tend not to do anything for a while. Again, they have a different source of return. They do have a slightly higher long-term return if you compare the small ordinaries index or a small index in the US compared to their large companies. They do have a slightly higher long-term return, so they provide some diversification benefit, as do growth and value companies. So your growth being standard, value being the out-of-favour companies. But it is important to keep in mind that doesn't always happen. So, for example, we're in a period of time for some time now where growth companies have actually outperformed value companies on the back of the tremendous returns from BHP and Rio. So that probably brings it to the end of the comments I wanted to make. Are there any questions at this stage?
Please go to the mic.
Okay, but I can repeat the question.
The franking
franking credits are not priced in. Can you go over that?
Yeah.
Are you also sort of saying that investors should be allocating more to Australian shares than they actually are because they're not? Are you saying that, or is there?
Yeah. So the mic works now. So the question was the franking credits. Can I go over what I meant by saying they're unpriced? And am I suggesting Australian investors should have more money in Australian shares than they do because of that? So by unpriced, what I mean is that long-term returns from stock markets have tended to be about 7% above inflation, above a lot of markets over a lot of time. So US data that goes well over 100 years, even Australian data that goes well over 70 years has suggested that's the case. And that returns comes from growth and dividends. And so about 15 years ago, franking credits came into the environment, and they're like a third source of return. But the research has suggested that the growth and income return stays very much the same, and the frankings are a little bit of extra return on top. And one of the theoretical reasons for that is that they say that a lot of the big investors in the Australian marketplace are international investors. They don't get any benefits from franking credits, therefore they're not prepared to pay extra for them. So that's one of there's a few theoretical contexts. But that's one. Would I say, should we have more Australian shares? I would say the average Australian, is very overweight Australian shares. There's a massive home bias in Australia. The Australian market is worth 2% of the world, and yet most of us would have far more in the Australian market than we would. So in a practical situation, I wouldn't see that in general terms. No, I think probably the argument is almost like the difficult decision is almost to go the other way. We've had 10 great years from Australian shares overall, a few blips in there, but generally the average return has been very good. Been pretty poor from international. The pull is to say, let's forget about Australian international shares, go